Welcome back to Facts Repo, your home for the most incredible stories from history and finance. Today, we're diving into a tale of colossal risk, immense fortunes, and how one man brought a global superpower's economy to its breaking point. This is the story of the man who broke the Bank of England. It's September 1992. The United Kingdom is in a precarious financial position. To stabilize its economy and foster closer ties with Europe, Britain has joined the Exchange Rate Mechanism, or ERM. The ERM was designed to reduce currency fluctuations between European nations, paving the way for a single currency, the euro. For Britain, this meant pegging the value of the British pound to the German Deutsche Mark, Europe's strongest currency at the time. The deal was simple: the pound would be allowed to fluctuate only within a narrow band against the Deutsche Mark. If the pound's value dropped to the bottom of this band, the Bank of England was legally obligated to intervene. This intervention would involve buying up massive amounts of pounds on the foreign exchange market to create demand and push its price back up. It was a commitment to maintain the pound's value at all costs, a promise backed by the full faith and credit of the UK government. For a while, the system seemed to work. But behind the scenes, economic pressures were mounting. Germany, reunified just a couple of years earlier, was facing its own economic challenges. The immense cost of integrating East Germany led Germany's central bank, the Bundesbank, to raise its interest rates to fight inflation. This decision had a ripple effect across Europe. Higher German interest rates made the Deutsche Mark more attractive to investors, causing its value to soar. Because the British pound was pegged to the mark, Britain was now in a terrible bind. To keep the pound from falling below its agreed-upon floor in the ERM, the UK had to match Germany's high interest rates. But Britain was deep in a recession. Raising interest rates would make borrowing more expensive for businesses and individuals, choking off economic growth and worsening the recession. The UK government was caught between a rock and a hard place: honor its ERM commitment and deepen the recession, or break its promise and face a currency crisis. This is where our main character enters the scene. George Soros, a Hungarian-born financier and the head of the Quantum Fund, had been watching the situation with intense interest. Soros was a master of a financial strategy known as short selling. Short selling is essentially a bet that the price of an asset will fall. Here's how it works with currency. A speculator like Soros would borrow a large amount of a currency they believed was overvalued, in this case, the British pound. They would then immediately sell those borrowed pounds on the market for a stronger currency, like the German Deutsche Mark. The speculator then waits. If their prediction is correct and the pound's value falls, they buy back the same amount of pounds they originally borrowed, but now at a much cheaper price. They return the pounds to the lender, and the difference between the high price they sold at and the low price they bought back at is their profit. It's a high-risk, high-reward strategy that thrives on economic instability. Soros saw the fundamental weakness in Britain's position. He believed that the pound was artificially overvalued and that the UK government couldn't possibly withstand the economic pain required to defend it indefinitely. He saw that the UK's commitment to the ERM was a promise it couldn't keep. So, he decided to force the issue. Soros and his Quantum Fund began quietly building up a massive short position against the pound. He started borrowing billions of pounds and immediately selling them for Deutsche Marks. His bet was simple: the Bank of England would eventually be forced to give up, devalue the pound, and he would make a fortune. Soros wasn't alone. Other major speculators and investment funds saw the same weakness and joined the attack. A tidal wave of selling pressure began to build against the British pound. The Bank of England was now in a fight for its life. As speculators dumped billions of pounds onto the market, the currency's value plummeted towards the floor of its ERM band. True to its word, the bank began to fight back. It started buying pounds, spending billions from its foreign currency reserves to prop up the price. On the morning of Wednesday, September 16, 1992, the battle reached its climax. This day would go down in history as Black Wednesday. The UK government made a desperate move. It announced a sharp increase in interest rates from 10% to 12%, hoping to attract buyers to the pound and signal its resolve. But the market didn't flinch. The selling pressure was relentless. Soros and other speculators knew the government was bluffing. Such high interest rates would be political and economic suicide if maintained. As the day wore on, the Bank of England was burning through its reserves at an astonishing rate, buying up pounds as fast as speculators could sell them. Reports later estimated the bank spent the equivalent of tens of billions of dollars in a single day. By mid-afternoon, with the pound still under immense pressure, the government played its last card. It announced another, even more drastic interest rate hike to 15%. It was a move of pure desperation, but it was too little, too late. The market called their bluff. The selling continued, and the Bank of England's defenses were crumbling. That evening, the Chancellor of the Exchequer, Norman Lamont, faced the nation. In a stunning admission of defeat, he announced that Britain was suspending its membership in the ERM. The government would no longer defend the pound's value. The peg was broken. The moment the announcement was made, the pound went into freefall. It crashed against the Deutsche Mark and the US dollar, losing over 15% of its value in the following weeks. The UK government was humiliated. It had bet the country's economic policy on the ERM and lost spectacularly. The event shattered the Conservative government's reputation for economic competence. But for George Soros, it was the trade of a lifetime. The pound had collapsed exactly as he predicted. His quantum fund began buying back the pounds it needed to repay its loans, now at a drastically lower price. The difference was his profit. In a single day, George Soros personally made an estimated $1 billion. His fund netted close to $2 billion. He had bet against a major government and won, earning him the title, the man who broke the Bank of England. Black Wednesday was a masterclass in high-stakes finance. It demonstrated how a single, well-capitalized trader with deep conviction could challenge the power of a sovereign nation's central bank. Soros wasn't a villain in a movie. He was simply a market participant who identified a massive, unsustainable imbalance in the global financial system and placed a huge bet on its inevitable correction. The market, in its brutal efficiency, proved him right. The story of Black Wednesday serves as a powerful lesson in economic history, showing the immense forces at play in currency markets and the catastrophic consequences of flawed economic policy. It's a reminder that in the world of global finance, conviction and capital can sometimes be more powerful than a government's promise. What do you think? Was Soros a brilliant strategist or a ruthless opportunist? Let us know in the comments below. Thanks for watching Facts Repo. If you enjoyed this dive into financial history, make sure to like this video and subscribe to the channel for more incredible stories. We'll see you in the next one.